This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's get to that chart deck. Listeners, you'll find the download link for a Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered for MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture that says Looking for the Downloads. Let's get to talking some of these charts. On page 2, we have the S&P 500. What levels are you watching?
Yeah, so looking ahead to next Friday's OPEX, the February monthly OPEX, the expected move is about 100 points in other direction. So current spot is around 4160. Upside would be 4260. Downside around 4060 or so. And keep in mind, looking at the support areas on the chart, they're pretty heavy at 4,000, then below at around 3,800. And then obviously, back at those October lows at like 3,600 or so. On the upside here, if we keep pushing to the upside, it's possible we touch 4,300 or so, which would be heavy resistance back from late August, late September of last year. But Eric, what are your thoughts here?
Well, a few weeks ago, we broke above the 200-day moving average, where a lot of our expert guests have told us is where bear market rallies often end. Since then, there's been a nice clean rally up to the 50% Fibonacci retracement at 4153. That's the 50% of the overall bear market. And we're now consolidating along that resistance. I won't be surprised to see a rally up to the 61.8% Fib retrace. That's 4308. If this really is a bear market rally, it ought to end by that point. And if the Fed really is done tightening and Jeff's prediction that they'll be forced to ease proves false, then I suppose maybe the bottom really is in for this market. But frankly, I think Jeff's scenario is more likely. So 4309 is probably your selling point to short this market if you haven't shorted it before that. And of course, if you think the Fed really has pulled off the soft landing and there's not going to be any more recession than there's already been, then I suppose the bottom is in. But that's not the way I'm expecting it to play out.
I find it interesting that all three of us have very similar levels in mind. Obviously, all eyes are on that August high near 4,300. Yeah, it lines up with the fib zone like you're talking about there, Eric, and certainly there's a substantial option open interest there as well. But I like to just really keep it simple here. And obviously, on one side, we have all the signs that maybe the raising of these rates will inevitably trigger some sort of an economic recession. But until the market wants to care about that, the prevailing trend is very distinctly, at least in the last month or more, the market wanting to go higher. And we continuously see accumulation, higher highs, higher lows. Each dip is being bought. And so you have to assume the path of least resistance is that prevailing trend to that very number that you guys are talking about. And but what will be really interesting to see for me is when we see the behavior of these markets start to shift. But there clearly is no sign of that. So I agree with both of you in terms of that upper level as being the point to watch here going into next week. So I want to talk about the NASDAQ here, Nick. And on those QQQs, what's interesting is from a percentage return perspective, the NASDAQ has had a really good run. But I think that's reflexive of the fact it's been just such a heavily beaten down market in the prior 2022 year, and then reflexively it's just simply just getting from such an oversold level to the upside. What's your take though on the levels here on the Qs?
Yeah, I mean, tech has performed very, very well this year thus far. We're up from the bottom back on January 6th or so, the recent bottom anyway. We're up about almost 20%, which is not inconsequential whatsoever in about a month's time, which is pretty crazy. But looking at, again, next Friday's expiration, February 17th, the expected move is about 10 points here. Spot is about 308, and the upside would be 318. Downside would be around 298, which also has support right around 297 or so. Mental support is around 300. And again, we gap filled that area of 310, 311 from a few months ago. So the next upside move would be somewhere around 320, then 330. There is a gap also from late August, early September, right around like 320 area or so. Again, we're seeing a lot of strength regardless of poor earning reports. And that tells me that there's probably more upside ahead. So, don't fight the trend, right? And you want to look at what's possibly going to happen this year. We had a terrible year last year in tech. It's possible this year is the year of recovery.
Yeah, well, I'm not sure I agree with that, but we'll see how it plays out. But anyway, let's move on, though, to the volatility index. And what was interesting is when we were recording last week, we had that breakdown below 18. It just looked like the feet was kicked out underneath volatility and it was going to head down. And it hasn't really recovered, but I would say it's more like it's come back into the trade range and that breakdown never followed through. But low volatility conditions continues to be the case. Does that change your levels in any way on the VIX?
Not too much overall. Looking at the current VIX spot is around 19.2 or so. Daily expected moves is about 1.2% in broad markets. Again, like support's pretty heavy at that 18 mark. We tapped 20 and then came back down again yesterday. And unless we get above 25, I'm not too concerned going forward. If you're a bull, short term, you might get a further rally, but being bearish in these type of dull markets where we get a bit of chop, gap ups and then more chop, it's kind of dangerous because again, you can be correct in your thesis overall that we may see lower lows in the future, which is what I think, but we also may not see that for a while. So if you time it incorrectly, you can still lose and be correct in your thesis overall, in long term, but not get paid for that, right? So that's a danger in shorting the market in the short term. You need to have a longer term approach. And again, being long in the market overall is a much, much better way to make your capital work for you. So the VIX right here, unless we see a spike above 25, I'm not too concerned right now. We could putter in this area for a little bit, but looking at the past year or so, we have historically bounced off pretty heavily, but that would probably require some kind of volatility inducing event. Earnings may have, I thought earnings may have been that event, but thus far that hasn't been the case at all. So moving on to page 5 with the US dollar, Eric, what are you thinking over here?
Well, the Dixie paused at 104 as support on the way down, and of course that support failed, and we moved almost down to 100. Now it's pausing just under 104 as resistance on the way back up. So the big question is whether it breaks above or rejects at 104 on the way back up. I don't have a strong view on which is more likely to happen, but what happens at 104 and whether it breaks higher or reverses and moves lower is going to be the tell that indicates where the next leg is going to go from here.
Yeah, Eric, you're bang on with that short-term high at 104. That is now a very important pivot because, look, the dollar was incredibly oversold. I mean, we basically had on many cross currencies, 2,000 plus pip moves on so many of them, and just such an incredibly short-term oversold dollar. And it was inevitably going to bounce, and we got a pretty violent bounce on in the post FOMC and jobs numbers reaction. But this is the moment of truth, because if we see that the dollar fades all the way back down to its lows, then nothing has changed. It means that the dollar was just oversold. It had a reaction. It faded back to its lows, and the prevailing trend is dominant. But at the same time, if we're recording this MacroVoices next week and the Dixie has broken north of 104 by then we have to really start entertaining the idea that the dollar that's been in more or less a 4+ month consolidation may be attempting another breakout attempt. I don't feel that I need to make that call with high conviction today. It's one of those things that we now can watch that 104 level on the Dixie and really just see whether the bulls can crack that level and squeeze the shorts here. And that's certainly something to watch.
Now, moving on to page 6, we have this chart over here of gold, which last week broke down surprisingly, or to my surprise rather, from the high 1900s level down to 1875 or so. What are your thoughts over here, Eric?
Well, I complained a couple of weeks ago that the only thing not to love about gold was that it hadn't given us any meaningful corrections to allow new longs to get into the market. Well, I guess I got what I hoped for. Last Friday, we had a slam down that looks to me like the beginning of that substantial correction. Now, I doubt it's over after 2 big down days. I'm guessing that what we're seeing in the last 3 sessions is just a dead cat bounce, and that maybe we'll get to new lows. I'm targeting the 38.2 fib retracement, which is at 1838, to add to my longs. It's entirely possible we could see lower numbers if this turns into a substantial correction. 50% fib retracement is at 1795. The 61.8 is at 1753. Healthy bull markets need corrections to shake out the weak hands, and gold is a famously volatile market, so more downside is entirely possible, but I see no reason to conclude that this bull market has ended. This is just the first meaningful correction in a new uptrend as far as I can see, and what the dollar does at 104 is probably going to indicate where the next leg in gold comes.
Yeah, Eric, I obviously am a big fan of Fibonacci. So when you're talking these levels, you are certainly talking levels that are on my charts as well. The one thing, though, is that to me, gold at this juncture has still demonstrated just simply its behavior of acting as a cross currency to the dollar. It's no coincidence that reversal off the top in gold lined up with the squeeze higher in the dollar. And just like I was talking about what's next for the dollar off of that 104 level, I think that in the same way it's going to determine at this moment whether or not gold has still deeper to go in this correction or not. I mean, if the dollar fades all the way back down to its lows and looks like it's staying in trend, gold may already be putting a short-term bottom. If we do have that deeper correction, if the dollar does squeeze a little higher, you're bang on. I'd love nothing more than to be able to reposition a new long on gold in the 1800 pocket. It's certainly the level to watch there. Moving on page 7, I wanted to talk crude oil, and I know you were talking about it earlier, Eric, and all I wanted to observe is that even though the last 2 days have seen a bounce off of that support line, the one thing I'm waiting for is when crude oil's price action is actually going to show some sort of sign of accumulation. I mean, there are all the cases to be made that at some point there's going to be another bull leg in crude. And the biggest puzzle piece for us to solve is when has that new trend begun? And at this stage, while we have bounced off that level, until we're in the low to mid 80s and really neutralizing this sell cycle that has demonstrated lower highs, lower lows, and just a prevailing downtrending pattern, until we see that, you have to respect the prevailing downtrend as dominant. If, for whatever reason, crude oil once again fails here to make a higher high and fails here at the 78 level, it becomes vulnerable for temporarily dipping to new lows just to psychologically wash out all those people that are so determined that the bottom is in. One way or another, I get the bull thesis. I'm looking forward to when the technicals line up to support that bigger view. The last thing I wanted to just touch on is those 10-year Treasury yields. And what's interesting is when you were interviewing Eric, Jeff there, talking about yields, talking about oil, all of these things were touched on. Obviously, with inflation coming back, you would think that naturally that would be a condition that would stop putting pressure on bonds and allow yields to some degree or another mean revert, maybe even as low as 2.5%. But what we see here is in the post-FOMC and jobs numbers, we had a jump in yields. But this jump in yields echoes a lot like the jump in the dollar or jump in all of these different moves. What I'm very curious about is whether or not there's going to be a prevailing bond weakness that pushes, let's say, bonds back to their lows or yields back to 4%. Because if all we see is a fade off of this little pop from 2-3 days on the upside of the yield, which obviously is testing that 365, 370 zone on the upper boundary of it. If it fades right back to 340, maybe there's more upside on bonds, and as yields just continue to back off in this condition. It's certainly such an interesting moment in the macro space as to whether these things that have been in place for the last 3-4 months, whether these trends really in fact are going to shift.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from bigpicturetrading.com, the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.